XRP is quietly moving from uncertainty to understanding, and that shift is exactly why global banks are paying closer attention right now. What's happening is not about hype or sudden price excitement, but about something far more important in finance, which is confidence, clarity, and the ability to plan for the future without fear of regulatory surprises. To understand why this matters, we need to rewind briefly to where XRP has been positioned in the broader crypto landscape. For years, XRP has occupied a unique space, not as a meme-driven asset or a speculative experiment, but as a digital asset designed with cross-border payments and institutional efficiency in mind. Built and promoted by Ripple, XRP was always aimed at solving real problems that banks and financial institutions face every single day, such as slow settlement times, trapped liquidity, and high transaction costs. However, despite the technology's promise, uncertainty around regulation created hesitation. Banks do not operate on excitement or ideology. They operate on rules, risk frameworks, and legal certainty. That hesitation has defined much of the conversation around XRP until recently. When regulators are unclear, institutions step back, not because they doubt the technology, but because ambiguity is a risk they cannot justify. In traditional finance, even a small legal gray area can stop a multi-billion-dollar institution from moving forward. This is why the evolving clarity around XRP is so significant. It signals a shift from speculation toward evaluation and from observation toward potential integration. The turning point in perception has been the gradual but meaningful progress toward regulatory definition, particularly in the United States. For a long time, the unresolved questions surrounding whether XRP should be treated as a security created a cloud over its future. That cloud did not just affect retail investors, but also compliance departments, legal teams, and risk committees inside banks. As clarity improves and legal interpretations become more concrete, those internal conversations change. Instead of asking whether XRP is too risky to touch, institutions begin asking whether ignoring it could put them at a disadvantage. This matters because banks are under pressure like never before. Cross-border payments remain slow, expensive, and fragmented. Legacy systems were not built for a digital-first, always-on global economy. Even messaging networks like SWIFT, while reliable, are not settlement systems and still rely heavily on correspondent banking structures that introduce friction. Banks know this. They have known it for years. What they have been waiting for is not a new problem to solve, but a compliant and reliable way to solve the old ones. As regulatory clarity improves, XRP increasingly fits into that conversation. Banks are not looking at it as a speculative asset to hold on balance sheets, but as a potential bridge asset that can move value efficiently between currencies and jurisdictions. This is a subtle but critical distinction. Utility, not hype, is what attracts institutional attention. When legal frameworks start aligning with technical capabilities, financial institutions take notice because that is where real transformation becomes possible. It is also important to recognize that banks do not move in unison or make announcements the moment interest appears. Institutional adoption happens quietly through pilots, internal testing, and strategic partnerships long before headlines catch up. Large players such as JP Chase and other global banks continuously evaluate emerging technologies, even when they publicly appear cautious. Regulatory clarity gives them permission to explore more seriously, to run deeper analyses, and to consider how a digital asset like XRP could fit within existing compliance structures. This is why the current moment feels different. It is not driven by social media narratives or short-term price movements, but by a slow recalibration of risk and opportunity. XRP's story is shifting from whether it can survive regulatory scrutiny to whether it can be responsibly used within the financial system. That shift alone changes the tone of every institutional discussion surrounding it. So the real question is not whether banks are suddenly becoming crypto enthusiasts. They are not. The real question is whether clearer rules are finally allowing them to examine XRP on its merits rather than its uncertainties. And as we move deeper into this clarity-driven phase, the implications for XRP's role in global finance become far more interesting than any short-term market reaction. As clarity improves, what changes inside a bank is not the headline strategy, but the internal language. Legal teams move from defensive postures to structured frameworks. Compliance officers begin mapping scenarios instead of issuing blanket prohibitions. Innovation departments are finally allowed to test rather than theorize. This is where XRP's position becomes especially relevant because it was designed from the beginning to work alongside existing financial infrastructure rather than disrupt it recklessly. Banks are not searching for rebellion. They are searching for efficiency that does not put their licenses at risk. One of the most important shifts has been the evolving stance of regulators themselves. The involvement of the U.S. Securities and Exchange Commission in shaping clearer boundaries around digital assets has forced the market to mature. While regulation is often portrayed as an enemy of innovation, in finance it often has the opposite effect. Clear rules do not kill progress, they channel it. Once banks can see where the lines are drawn, they can begin designing systems that stay firmly inside them. XRP benefiting from this process is not accidental, it is structural. Banks care deeply about one thing above all others, and that is settlement finality. When money moves across borders today, it often passes through multiple intermediaries, creating delays, costs, and uncertainty. XRP's model, particularly when used as a bridge between fiat currencies, offers a theoretical reduction in all three. But theory is never enough for banks. They need legal certainty, predictable treatment, and assurance that using such a system will not expose them to future enforcement action. Regulatory clarity transforms XRP from a theoretical efficiency into a practical option worth testing. Another factor driving attention is competition. Financial institutions are not only competing with each other, but also with fintech firms and payment providers that move faster and operate with lower overhead. If a bank can reduce settlement time from days to seconds while remaining compliant, that becomes a strategic advantage, not just a technical improvement. As clarity increases, ignoring tools like XRP becomes a potential liability. No institution wants to explain to shareholders why it dismissed a compliant efficiency upgrade that competitors quietly adopted. It is also worth noting that banks rarely adopt technology directly at scale without layers of abstraction. They rely on service providers, liquidity partners, and infrastructure companies to handle complexity. As clarity improves around XRP, those supporting ecosystems gain confidence as well. That creates a multiplier effect. When one regulated entity becomes comfortable, it enables several others to follow without taking the first mover risk. This is how adoption spreads in traditional finance, not through bold announcements, but through quiet normalization. This moment also reflects a broader trend in crypto itself. The market is maturing away from purely speculative narratives and toward utility-based evaluation. Banks are not interested in narratives. They are interested in measurable outcomes. XRP's renewed attention aligns with this shift. It is being discussed less as a token and more as a tool. That change in framing is subtle but powerful. Tools can be evaluated, regulated, and deployed. Narratives cannot. As these conversations deepen, the focus naturally turns to what comes next. If clarity continues to improve, what does real-world usage look like? How do pilot programs transition into live environments? And what signals should observers watch for to understand whether banks are truly moving beyond observation into execution? When banks move from interest to experimentation, the process is far more methodical than many outside the system realize. It begins with controlled pilots, limited corridors, and strict parameters. No major institution flips a switch across its entire payment network. Instead, it tests specific use cases where inefficiencies are already well understood, such as remittances between high-volume currency pairs or regions with costly correspondent banking chains. In these environments, XRP's potential role as a bridge asset becomes measurable rather than theoretical, and that is where confidence is built. What makes this phase especially important is that experimentation does not require public announcements. Banks can explore XRP-related solutions through sandbox environments, partnerships, and proof-of-concept trials without ever signaling a full commitment. This quiet testing is often misunderstood by the market as a lack of interest, when in reality it is the strongest signal that interest is serious. Institutions protect optionality. They gather data before they gather attention. Regulatory clarity gives them the protection they need to run these experiments without fear of retroactive consequences. Another key layer in this process is liquidity management. Banks care less about price volatility in the abstract and more about whether sufficient liquidity exists at the moment of transaction. XRP's design addresses this by aiming to source liquidity on demand rather than requiring pre-funded accounts across the globe. For banks, this has profound implications. Capital that once sat idle in foreign accounts could, in theory, be redeployed elsewhere. That is not a crypto talking point, that is a balance sheet consideration, and it is exactly the type of efficiency senior executives care about. We are also seeing a shift in how compliance teams engage with digital assets. Instead of blanket exclusions, they are developing asset-specific frameworks. XRP benefits here because its use case is narrow and transactional rather than speculative. That makes it easier to define controls, reporting standards, and risk thresholds. As clarity increases, these frameworks become templates that can be reused, reducing friction for future deployments. Once a bank builds a compliant pathway for one digital asset, expanding its usage becomes incrementally easier. It is important to understand that banks do not adopt technology in isolation. They watch each other closely. When one institution successfully tests a new settlement method without regulatory fallout, others take note. This is how momentum builds in traditional finance, not through bold predictions, but through validated outcomes. XRP's progress toward clarity positions it to benefit from this dynamic. It does not need every bank to move at once. It needs only a few to demonstrate viability. At a broader level, global standard-setting bodies such as the Bank for International Settlements continue to emphasize the importance of faster, cheaper, and more transparent cross-border payments. Banks are under pressure to align with these objectives. Solutions that can demonstrate compliance while improving efficiency naturally rise in relevance. XRP increasingly sits within that conversation, not as an outsider, but as a candidate under evaluation. As experimentation matures, the conversation inevitably shifts from whether XRP can be used to how it would be used at scale. What governance models emerge? How are risks shared? And what role do central banks, commercial banks, and infrastructure providers each play in that ecosystem? These are the questions that define the transition from testing to implementation. As these experiments move closer to real-world application, the long-term implications for XRP become clearer. The conversation is no longer about survival or legal defense, but about positioning. In finance, assets that achieve regulatory clarity gain something far more valuable than short-term attention. They gain legitimacy. That legitimacy allows institutions to plan years ahead instead of quarters, and planning is where real adoption begins. Banks do not commit resources, staff, and infrastructure to solutions that might disappear under regulatory pressure. Clarity transforms XRP from a question mark into a variable that can be modeled. What makes this phase particularly important is that it reshapes expectations. Instead of watching price charts for sudden reactions, observers should be watching behavior. Are banks expanding pilot corridors? Are payment providers integrating digital asset rails alongside existing systems? Are regulatory conversations shifting from classification to implementation standards? These are the quiet signals that matter. Markets often react late to these developments because they unfold behind closed doors, but by the time they become visible, the groundwork has already been laid.